Hello to everyone. Today I am here with Introduction to Corporate Finance Part 2 in order to grasp the concept of the topic. Please do watch my video till end. Secondly, if you are interested to have update videos on banking and finance related topics, please do subscribe my channel. In this session, we are going to cover the cash flow between the firm and the financial market, the financial market structure of and the structure of financial market, the Fisher separation theorem, Arrow's impossibility theorem, the investment decision, the implication of the Fisher's analysis, the cash flow between the firm and the financial market. First of all, we have two areas, the total firm's value of assets that includes invest in assets, current assets, non-current assets. On the other side, the total financial value of the investor that includes short-term debt, long-term debt that is borrowed externally, normally externally, and can be internally as well. On the other side, shareholders' equity. The first step is the firm enter in the financial market and issue securities in the shape of short-term securities like notes payable. On the other side, long-term liabilities like term finance certificates, bonds, etc. as debt instruments. On the other side, shareholders' equity as preferred or subscribed shares in the stock market. Thereafter, the money generated from the debt and equity capital is invested in assets that are tangible and non-tangible assets. On the other side, current assets to meet the working capital needs or the running finance needs. Thereafter, non-current assets that include long-term investment and tangible and intangible assets. The cash flow generated from the firm's assets. Third step is the cash flow generated from the firm's assets are utilized to meet the government taxes. As fifth step, they retain a part of the profit and retain earning to the firm back. Thereafter, on one side, they meet their financial obligations against the short-term and long-term debt and pay dividend to the shareholders. So it's a small relation or a brief relation between the firm and the financial market cash flow. The financial markets bring together the buyer and the seller of the financial debt and equity securities. As we have already discussed, what do you mean by the debt securities and what do you mean by the equity securities? The markets in which financial securities are traded, first of all, include the money market, involve the trading of short-term debt securities. In the money market, liquid securities and the securities having the maturity period less than a year are traded. Capital market involves the trading of the long-term debt securities, like long-term loans, bonds, term finance certificate, etc. Banks act both are as money and capital market, as a part of money market and a part and capital market. Now, other markets include the primary market, involve the origin or fund first time sale of the security. because the security sale first time, the money will directly come to the firm either as capital equity or capital debt. Secondary market involve the continual buying and selling of the issued securities. Means the securities which are already issued, those securities are traded between investor to investors. So it's a difference between the primary and the secondary market. Structure of financial market, money market and capital market, both having sub primary and secondary market, for money market and for the capital market. Fisher's separation theorem. In a perfect capital market, it is possible to separate the firm's investment decision from the owner consumption decision. So, Fisher's separation theorem explain about the possibility to separate the firm's investment decision from the owner's consumption decision. Arrow's impossibility theorem, where there is an imperfect market, there is no longer a unique production decision that would be made by any current owner regardless of the preference of the owner. So it's the statement as a part of Arrow's impossibility theorem, which emphasizes the involvement or the preference of the owners for any type of unique production decision. It may be in an indirect way if the owners having the confidence on their management, they can give the authority to the management for such decisions as well. Investment decision, the point of the wealth and utilizing maximization for all shareholders can be reached through one of the two routes. One of two rules. Net present value rule. Invest so as to maximize the net present value of the investment. How we calculate the net present value? It is the sum of initial cash outlay and present value of net cash flows. If the net present value is positive, the business is earning more than its expected return. If it's negative, it means its return is less than the expected business returns. Business is only expected if the net present value of the investment is positive. Second one is internal rate of return rule. Invest up to the point at which the marginal return on the investment is equal to the expected rate of return on equivalent investment in the capital market. So here The management is expecting a minimum return equivalent to the return on the capital market. But it depends. Every business or every individual having the different opportunity cost. Get forego before entering in any type of a business. Someone might have equivalent to capital market return. Someone may have more than capital market return, or someone may have less than capital market returns. In my view, it varies from management to management or individual to individual. Capital return cannot be kept as a benchmark. Benchmark can be treasury return as well, or any other types of the return in which you can feel comfortable and having the confidence. Implication of Fisher's analysis, it is only investment decision that affect firm value. Firm value is not affected by how investment are financed and how the distribution are made to the owners. So investment value having different parameters that can, again I will say, vary from management to management or person to person. Thank you very much. See you again very soon with the upcoming video on the similar topic very soon.